In this short video, let's try and see how we can buy or sell correlation, and we'll try and do it using variance swaps. Now, before we take a look at what kind of trades will be required, let's clarify three things. The first is, what is the meaning of buying or selling correlation? If I were to buy correlation, it means that I would want a long exposure on it. A long exposure means that I want to make an economic gain or a benefit if the correlation goes up. Alternatively, a short exposure would have been one in which I stand to gain if the economic variable, and in this case that's correlation, were to go down and not up. Okay, so I would want to build or set up trades which give me a gain if the correlation goes up. So that's my aim. Okay, I can very well then reason out what kind of trades will be required if my aim was to actually sell correlation. So in the entire analysis that we'll do, I'll be sticking to what needs to be done to buy correlation. The second thing which we have to keep in mind is that this buying or selling of correlation, this can very well be done using simple call options or simple put options, or for that matter combining the two and trading in straddles. The reason why we are not going the options route and sticking to variance swaps is because yes, the options, they do respond the way I want them to when the correlation changes, but the problem with options is that they have that extra variable, the spot price, that I need to worry about. If the correlation indeed moves in a direction which I want it to move in, the gains which I get can be offset by the path which the stock price takes. The stock price can take a path in which the gains from my favorable moves in correlation might be completely wiped out, and it may even result in a loss for me. Okay. So since I don't want to be, worrying about, controlling the spot in some way or hedging the spot in some way, what I need is a much more purer play on the volatility and the correlation. And it's the variance swaps that give me that much more purer play. Okay. The third thing to keep in mind is that in this entire analysis that we'll do, we will stick to a very simple case, and that is the case of a two asset or a two stock basket. Any results that we get from this very simple case, we would hope that those results can be extended to the case where you have more than two underlyings. Let's say the case of n stock basket, in which case we will have NC2 number of correlations, n into n minus 1 by 2. And in that case, the trades that we'll be talking about will be trades that give us an exposure to the average correlation of the basket. Okay, so let's begin. The guiding relationship that we should keep in mind is how the volatility of the basket, let's write it down, let's call it sigma b, or I should say actually the variance of the basket, sigma b squared, how it is linked to the variance or volatilities of the individual stocks. I'm assuming that the allocations which this basket has to stock 1 and stock 2 are respectively W1 and W2. So the variance of my basket very simply is W1 squared sigma 1 squared plus W2 squared sigma 2 squared plus 2W1 W2 rho 1 2 sigma 1 sigma 2, and it is this rho 1 2 that I am after. I need a trade which gives me a gain when this rho 1 2 goes up. So let's start on a very simple note. Let me assume I am B, the bank. I want to get a long exposure on this correlation. Let me just go and trade a variance swap on this guy. Okay, that means the underlying whose realized variance I will be exchanging against some kind of a fixed variance via this variance swap will be my basket. Okay, so since I want to gain when this correlation goes up, it means I want to gain when this variance goes up, because this going up means this goes up. Okay, so if that is my intent, I should enter into a variance swap in which I receive the realized variance of my basket. Let's now adopt a certain nomenclature. Let's call it the variance of my basket realized over, let's say, a period 0 to capital T. Okay, so against this I'll be paying some kind of a fixed variance. Let's call it sigma squared K, and this is, I'm sorry, sigma squared B, because I'm denoting this as my underlying B. Then I write down whether it's fixed or realized. So sigma BK, and then over the period 0 to T. Okay. So when I decide to get into this trade, I need to also specify something called a variance notional. Let's denote it as NAB. Okay. Now, if I were to write down what is the payoff of this trade to me, and the payoff will be the notional, which is NAB, that times the difference between what I receive, which is this, and what I pay, which is this. Okay, so it will be sigma squared BR0T, that minus sigma squared BK0T. Okay, now if I were to ask you what is the value of this variance swap as shown by, let's say, my risk management system, in which I will book this trade as of, let's say, any time T, which is in between when I start, which is 0, and when I finish, which is capital T. Okay, so to write down the value, let me write it down as VBT. I can very simply write it down based on this payoff. Let me write it down first and then we'll reason it out. This will be equal to some kind of a discount factor, and this discount factor will be between time T, which is today, and capital T, at which I'll receive this payoff. Okay, then I will write down this guy. This is simply a scaling factor, the notional. And then what I can do is I can take this realized variance term and I can split it into two parts. There will be some portion of this realized variance which I would have already realized by the time T, and there will be some portion which I am yet to realize. That portion which I am yet to realize, it depends on what is the market at that point in time. What is the implied volatility of my basket at that point in time, which will depend on the implied volatilities of the constituents and on the correlation prevailing at that point in time. Okay, so let me write this guy, the realized variance, to be a sum of two components, one which has already been realized. So I'll write it as sigma squared, that of B already realized from 0 to T. I need to somehow weight this portion, because this portion is not the entire thing that I'll be paid. I'll weight it depending on the time. Okay, so it'll be T upon T, the proportion of the entire period over which this accumulation of realized variance has to happen, and I'll just take that proportion which has already been realized. Okay, then the other half, or the other portion, I should say, should be sigma squared BK. Now take a look at my nomenclature. I'll write lowercase t to t. This guy basically means it is the fair variance of my basket as quoted in the market as of this time T, when, let's say, new conditions are now prevailing in the market. Okay, if I were to go to the market and trade a fresh new variance swap for this period of lowercase t to capital T, this would be the fair variance of that new variance swap. Okay, I need to then weight it by a certain portion of the period, and that is the remaining period T minus T, that divided by the whole period capital T. Now if you have actually this minus what I need to pay, and that is sigma squared BK0T, the fixed variance as was quoted to me when I did this variance swap, and that was at time T equal to 0. Now if you have any doubts with respect to this formula, I can quickly do a sanity check. Let's place ourselves at time T equal to 0. Now I would imagine that this swap, when it was done, it was a fair trade, and hence the value of this swap at time t equal to 0 should have been a 0. Okay, let's quickly check this. In this formula, just put this lowercase t equal to 0. What do you get? This term goes away because this t is 0. This term is 1. It's t minus 0 upon t. This term is sigma square bk0t. This is sigma square bk0t. This and this cancels, and you get a 0 for your value of my variance swap at the time we begin. Okay. Now, if this is the trade in my risk management system, let's quickly check how this trade behaves if indeed the inputs to valuing this trade were to change. The input which I am after is actually rho 1, 2. That is the correlation which I want to have an exposure on. So when rho 1, 2 increases, what happens? Take a look at this value of my trade. What will happen is that the market, it will take this rho 1, 2 increase into account, and it will increase this guy. Because my guiding formula tells me that as rho 1, 2 increases, the sigma b square increases. So this guy increases, this guy is already realized, it doesn't change. This guy is fixed, it doesn't change. Take a look at this formula. This value of my trade, as noted and valued by my risk management system, will go up when rho 1, 2 increases. So that's what I wanted, and I think I have been successful. Okay. Now, but what if sigma 1 and or sigma 2 were to decrease? How will I be impacted? If any of sigma 1 or sigma 2 were to decrease, our guiding formula of the basket variance, it tells me that the market will factor in that decrease in sigma 1 or in sigma 2. I'm talking here about implied volatilities of stock 1 and stock 2, and its fair variance from that point onwards will be brought down. Okay, that means this guy will come down because of this. So rho 1, 2 causes it to go up, and the gain that I am about to receive because of that may be completely offset, or it may even become a loss if sigma 1 and or sigma 2 were to go down and bring this term down with it. Okay, so for this case, your VBT, the value of the trade in my system, might go down, and I might not make a gain because the correlation had gone up. So therefore, the problem with only trading a single variance swap, and that too on the underlying basket, the problem here is that I did not take into account the fact that even the sigmas of the individual constituents of the basket might change. So let's do this. Let's try and build a set of trades in which the exposure which I have to sigma 1 and or sigma 2 is somehow taken care of, and the exposure now is then only focused on rho 1, 2. To do that, let's stick to the trade that we have done, and that is on the basket side. That means I'll be paying fixed, I'll be receiving the realized, okay, and this trade was done using a notional NAB. Along with it, let me do a trade, two trades actually, which are on individual variance swaps on the two underlyings. So for underlying stock 1, let me do a trade in which this time I do the opposite. That means I will be receiving the fixed, not paying. Let me carry with the same nomenclature. It will be variance of 1. I will be receiving fixed. That means fixed from 0 to t. I'll be paying the realized. That means sigma squared of 1 realized from 0 to t. Let me do this trade in a notional NA1. I'll quickly tell you what this NA1 is. At this stage, just note that it is some notional NA1. The same thing, let me do it for stock 2 as well. Again, I'll do the opposite of what I did on the basket side. That means I will be paying the realized. That means sigma square of 2 realized from 0 to t, and I'll be receiving fixed. So sigma squared of 2 fixed from 0 to t. This I will trade notional NA2. Okay. So let me quickly write down the values of these two trades as shown by my risk management system. When I insert these two into my system, I'll just write down the value based on this expression. So the value of trade this guy at any time t, it will be equal to NA1 that times some kind of a discount factor. This times, see, I'll be receiving fixed. Let me write it down. So sigma 1 squared K0T, and I'll be splitting this term into two parts. Okay, so it will be minus sigma 1 squared realized between 0 to t, weighted by the proportion, that's t by t, and then I will also subtract from it the fair assessment of the variance which is yet to come, and that will be sigma 1 squared k t to t. If I were to go and trade a new variance swap on underlying one at time t, this is what will be quoted to me. Okay, so this times t minus t upon t. Okay, I can write a similar relation also for v2t, okay, the second leg, and it will be na2 that times df from t to t. Just replace everywhere 1 with a 2, and it will be sigma squared 2k 0 to t minus sigma squared 2 realized from 0 to lowercase t that times t by t minus sigma squared of 2 fair variance as of today for stock 2 weighted by the remaining period, okay, t minus t by t. Now take a look at what we have now. We have a bunch of 3 trades, and let me write down the total value now, and that will be VB. Let's write it as V total. It will be VBT this trade plus V1T this trade plus V2T this trade. Okay. Now I had told you that we need to size these trades in some way, NA1 and NA2. We need to compute our variance notionals for trade 1 and for trade 2. Now keep this thing in mind that I would want to size my two individual legs in such a way so that the combination of all these 3 trades has a 0 Vega with respect to stock 1 and a 0 Vega with respect to stock 2. The reason I'm saying so is because we need to somehow remove the dependence of the entire set of trades that we are doing to the implied volatility of stock 1 and stock 2, and therefore my conditions are, let me size up NA1 and NA2 in such a way so that the total Vega becomes 0 for stock 1 and 0 for stock 2. So that's my guideline for selecting NA1 and NA2. Quickly, let's take a look how we stand. So row 1, 2, if it were to increase, that's the case that we have in mind. What happens? If row 1, 2 were to increase, this guy will go up. Because this guy goes up, VBT will go up. So in my total value formula, this guy goes up, these two remain the same because row 1, 2 will not affect the V1T and the V2T. So overall, the V total of this trade goes up. That's what I wanted. Okay. What if sigma 1 and or sigma 2 were to fall? That's the adverse risk, an adverse scenario in my mind. Okay. If sigma 1, let's say, were to fall, what happens? If sigma 1 falls, this guy falls. If this guy falls, VBT falls. So in this case, let me write down. So VBT falls. If sigma 1 were to fall, take a look at this expression. This guy is fixed, doesn't change. This guy is already realized, doesn't change. If sigma 1 falls, this guy changes. The fair variance quoted by the market moving forward falls down. But this guy has a negative sign in front of it. If this guy falls down, this trade makes a gain. Okay, so this is what I see. This trade is not affected. So 0 impact for this trade. So now, since I sized up my trade such that the Vega is the same. I mean, the Vega of this guy with respect to stock 1 and this guy with respect to stock 1 is the same and offset one another, and hence the Vega total is a 0. Therefore, this guy and this guy will completely offset one another, and therefore because of sigma 1 decreasing and or sigma 2 decreasing, we will not have any impact, ideally speaking. Okay, and therefore what I now have is that I have a bunch of trades which, as I wanted, give me a positive long exposure to the correlation rho 1 2. Now very quickly, you should keep this thing in mind that if I were to do the reverse trade, that means if I have to sell correlation, I have to get a short exposure on this rho 1 2. What will I do? I will do everything in reverse. That means on the basket side, I will do a variance swap in which this time I will be paying the realized, receiving the fixed. On the individual side now, I'll be doing variance swaps in which I'll be receiving the realized and I'll pay the fixed. Again, I'll size up these trades so that the entire bunch of trades taken together has a 0 Vega with respect to the individual stocks' implied volatilities. Okay. One more thing to keep in mind. If you've sized up these trades so that they are Vega neutral at any point in time, it's not really a static kind of sizing. As the Vegas keep changing, as we keep moving forward, you might have to go and rebalance this trade to a certain extent. Okay. So this was a quick look at how we can buy or sell correlations using variance swaps.